Split during Opex? Does RC know something we don't know? No, I think RC knows the exact things we know. That's the beauty of it, Grandpa John. BBBY hit 53.90 during Jan 21 sneeze. Besides the share buyback changing the float, why would it hit 150? The options interest on it right now is fucking crazy. There's like 50 calls to every put out of the money. There's a hedge of the entire float at $10. Can you go into detail about what the timing of the split falling on the day after Opex covering is so significant? That's when shares are needed the most, right? It's before the entropy swap is closed, and it's when the market maker exposure is the highest, right? Because all of the calls for Opex have just run into the money, like a massive chunk of the call chain. Say we move up to like 180. So all strikes from 120 to 180 are now in the money. The market maker now has a massive gamma imbalance carrying over T+2, which is the date of the split. Right? And now they need to find all that liquidity, and the price of the stock just became cheaper. So now they have to compete on the open market with all this FOMO buying that's going to come in because now the stock is cheaper. It's a situation, you know. It's going to be pretty interesting. And they haven't closed out the entropy swap yet, and the long side hasn't capitulated on their calls. And until they do that, they have to continue to hedge up, right? And that's why we get those feedback loops of T+2 after the Opex run. Like, we've talked about this a bunch in the past, but I'll cover it one more time. If we go out to the 1 hour here and we look at the March run, right? This is the Opex covering's actually not that big of a part of the run, right? This is the Opex covering for the most part. This is not March. Hold on. Gotta go further back. There we go. So here's where we start to see Opex covering begin. Oh, that's thick. Let's see if I can get a better color so it's a little more visible. So this is where Opex covering starts to begin, right? And this is where it ends. This is like the T+2 day. So all the obligations at this point are covered, right? But now all these calls from, you know, the low at $75 to this high at 158, these are all in the money now, right? And so that kicks off a T, this is the T date, +1, +1. And then we start to see market maker covering, right? And then that's T +1, +1. And then we see more market maker covering, right? So this kicks off that feedback loop. And by effectively splitting right here, right, the stock would split on this date. That's going to drive a massive amount of buying FOMO into the stock, which is going to increase the amount of gamma exposure on the market maker, right? It's going to drive up gamma max. Because now all of a sudden there's a new call chain where out of the money calls are super fucking cheap, right? And remember, when they buy out of the money calls, gamma maximum goes up. And the market maker wants to break gamma max so that entropy swap can be closed and retail gets priced out of options, right? So two things happen after we cross gamma max. The gamma expansion begins to widen, right? Which creates risk on the market maker. And option contracts become vastly more expensive, right? Because all the increased volatility, the higher delta cost, they're hedging the upside far more. And so, generally what they do is gamma expands after we cross gamma max, they close their entropy swap, which collapses. So you have gamma expanding out into this, right? And then they close the entropy swap, which collapses gamma. And then they're able to start bringing the price down. And that's when we see that big spike in gamma neutral, where gamma neutral comes up and crosses gamma max. I think this is kind of theoretical. But basically, at this point they can begin shorting. But if the opposite happens, right? If all of a sudden at this point retail starts buying large numbers of calls, gamma can continue to expand, right? And this is what happened in January is the gamma just kept expanding, right? And it started to create really, really high volatility, which starts to put the like volatility swaps at risk, right? And that's where we start to see like the massive amount of out of the money calls being purchased and sold, like those $1 puts and those 950 calls like a year out. Those are the hedge on the volatility swap, right? Because one has no vega, the other has some vega but no delta exposure, right? So like the $1 puts have no vega, and the 950 calls have vega, and that allows them to like try to hedge down that volatility burst, right? But if it keeps expanding, they have to keep hedging, and then the more they hedge, the more shares need to be bought at the market to hedge the contracts they're buying to hedge their volatility positions. And so you kind of get another feedback loop going where they're attempting to hedge down volatility, but the market makers delta hedging at market, and that continues to drive price action in massive amounts of volume. And so he's put it in an interesting position. I don't know with the NSCC 002 rule change that changed the way that they handle the hedging of volatility swaps in a high volatility environment could prevent Volga-Vada squeeze from happening, at least at the lower levels like it did in January. But we hope that, we see something out of it, obviously. It's well timed, I'll say that much.